Welcome back, Wealth Builders. Michael Rosmer here with Richucation. We're going to explore a second piece of real estate, not an actual piece of real estate, but the next thing about it, to understand where the returns come from in real estate, okay? So when we're talking about real estate investing versus real estate trading, like flipping or the real estate business, we're not talking about those. We're talking about real estate investing, which is buying property, owning it, ideally set and forget, getting a rate of return. Where do you get the good returns? Okay? That is the real question. Okay? So the returns on real estate are in financing. Okay? Real estate is a financing game. Period. Clear title real estate is a shitty investment. Okay? And I'm going to demonstrate that to you using the actual math. I was kind of shocked when I saw this, and it's a big deal. Okay. So, what's a good rate of return? Okay, a good rate of return is probably like 1% a month. Okay, that's a good rate of return. Let's call it 10 to 12%, somewhere in that range. Good rate of return. Great rates of return are like 15 to 20%. Anything above that is stellar. Okay? Ridiculous. But we want to target pretty high, right? Usually, my belief is, the reasonable target that people, like once they get into investing, should be targeting is kind of that 15 to 20% range. Okay? As a sole investor, doing private deals, there are some things that you can do that give you some advantages that make that very attainable. Okay, so can real estate do that for us? In fluke, yes. Okay, so if we're just talking about clear title real estate, just think about real estate as a vehicle. What have we got? Well, we have rental income. Okay, there's no principal pay down in the case of a clear title property, so it's just rental income. What are we going to get for rental income? Like our cap rate is like 7%. Very best case scenario, you're at like 12% typically. Very rare. Okay, there are some like rare occasions where in a short-term market you might get better than that, but just the economics are such that that will not be sustainable. Okay, so over the long term, a 7% cap rate is a reasonable cap rate. Okay, for if you're like picking for that quality, right? It could be much lower, but let's say 7%. So does a 7% rate of return meet our criteria of being a great return? No, it does not. Okay. Now, and that's fully taxable, by the way. Okay, so that's not great. So we're targeting, we want to get to that 15 to 20% range, right? How do we get to that 15 to 20% range? Very interesting. Very tough to figure out here. Okay. Well, of course, you've got some appreciation as well. Now, here's what we know. Appreciation over the long term, the data shows, matches inflation. Okay? That's what it's going to do. It's going to match inflation. By the way, that 7% doesn't necessarily account for loss of various expenses. So by the time we're out, we might be there in it for 4%, right? So we've got a 4% return so far. We've got a big gap to close. If you take the assumption that prices double every 10 years, which they do not, that would be a 7.2% rate of return, approximately, right? Now, so they don't, if you hit a boom, yes, you can get something where you go up 20% in a year, okay? Even then, though, if you just do that for 1 or 2 years, that's not great. It's not a fantastic return. If you're doing it consistently, yes, it's amazing, okay? But you're not going to do it consistently. Over time, you're going to find that real estate prices tend towards the rate of inflation, okay? You can get booms, you can get busts, but they're going to tend towards the rate of inflation, all right? So let's call that 3% a year, okay? Now, we've got a few things that are going to happen here. So we're up to about 7%, about 4% plus about 3%, right? Now, those will both grow at about the rate of inflation. Will rents rise with inflation? Yeah, pretty much. Will real estate equity prices rise with inflation? Yeah, pretty much. Can we have a period where it might go up dramatically? Yes. Will it continue to outpace the market like that? No, right? Because we're going to hit affordability issues, okay? So if we want really great rates of return, let's say for the sake of argument that we can get 5% in appreciation, okay, because we picked the location well and we understand the fundamentals and all these kinds of things. We're going to get 5%, okay? Little over that that process, which, by the way, another way to make money is in real estate is buying for less than it's worth, but I'm going to show you in a minute why that doesn't help you that much, okay? All right, so what are we going to do here? Well, it's like, all right, I think I'm going to, so I'm going to maybe optimize my rents a little better. I'm going to maybe, do this thing. I'm like maybe at 8, 9, 10%, right? Maybe I'm getting 10% if I really run it really, really well, okay? 10% doesn't, it's like half of our goal, 20%, right? And that's not on a risk-weighted basis either, okay? Now let's assume that we use some leverage, okay? So we're going to leverage at what we call 80% loan to value, which means that on a $100,000 property you put down $20,000 and you have $80,000 mortgage, okay? What does this effectively do? Okay, so what this does is if the property price on that $100,000 property goes up by 5%, right, then what is our rate of return? Let's look at this. So we have $20,000 in, okay, 20K in, property is 100K, okay, times 5%, okay, equals dollars. We're going to get $5,000 of appreciation, okay? Which as a percentage on this, what is that? That's a 25% return, okay? And the reason for that is we basically have 5 times leverage, okay? So this equals a 25% rate of return, okay? Let's just assume that all of the cash flow is going into paying for all the expenses, etc., the vacancy, the risk, the property management, all that stuff. So we have no cash flow. We're just going to pay attention to this because honestly, the cash flow really you might get a little bit of differential between the cash flow and the mortgage cost, but mostly it's going to get chewed up, right? The mortgage, let's say we had that 5%. It gets chewed up by, 3% of that is gone on the mortgage, right? So you've got 2% left, but you've got some risk weighting in there, okay? Okay, now, so we're thinking, okay, 25%, really good. That's above our target, right? And this is super easy. We got 5% on the property, not a lot, right? Not a high, this is not an aggressive number. And, we got 80% loan to value, again, not an aggressive number. Every bank will give this to you, provided, you meet very basic criteria, okay? So we're like, all right, well, that seems good. I'm pretty happy with this 25%, and I'm pretty happy with that 5% gain. Well, now let's fast forward, though. Let's say that over 10 years, okay, over 10 years, the value of the property doubles, okay? So it goes up to, or over whatever period of time, it doesn't matter. Okay, so it goes up to $200,000, okay? Which is, right now, talking about 100% growth, okay, over whatever period. Okay, so that's $100,000 of growth, okay, 100K. Now, what have we got? Well, now, so we're at $200,000, okay? So now, what have we got? We've got equity of $120,000, okay? Meaning that the portion of the mortgage, assuming we haven't done any principal pay down, let's just say that the principal has just continued. So we have $80,000 mortgage. We had an interest-only mortgage, okay? It was a home equity line of credit or something, okay? So now, the price on this $200,000, it goes up by 5%. So that's $10,000. So if it goes up by 5%, do we get our 25% return because we've got our mortgage? No, no, no. Now, this is going to equal an 8.3% return, okay? Because it's the $10,000 divided by $120,000. You see that? So this is the problem, is that as the longer you hold this property, your equity is increasing, okay? Now what happens to your equity? Does your equity grow at this 25% return? No, no. It grows up like the rate of inflation. Yeah, it helps maybe a little bit with your rent, this sort of thing. Your principal paydown grows at the rate of your mortgage. So you're talking about it's compounding at a rate of like 3%. If you were at a high mortgage, if it was a 12% interest environment, it'd be like, okay, we're getting some good return on this money. Let's pay that bad boy down. But that's not the situation. Okay, the situation is we're losing out because of the fact that we're tending to we will trend, because notice that this is the that's the appreciation, right? So notice how it's trending towards the 5%, right? It's going to, over time, the more we have our equity build up, the more our appreciation is going to trend towards the actual appreciation, and rather than this high 25, unless we refinance it, okay? So the whole game in real estate, the entire game in real estate is about maximizing your financing. Why should you buy a property that has great cash flow? So that you can increase your financing. Why should you buy a property that's undervalued? So you can get financing. So you can refinance it. Why should you go and renovate? So that you can refinance, pull out more equity, this sort of thing. The game in real estate is a finance game. Let's say, as an example, that you could buy for 10% below market value. Okay, so you buy this property for $100,000, or sorry, it's a $100,000 property, you buy it for $90,000. Big whoop. If you were to turn around and try and sell it, what have you got to do? Actually, let's use a higher value. Let's say it was $300,000, you bought it for 10% below market value, so you bought it for $270,000, okay? Well, so why is this not a great thing? Well, let's say I take that property. So first of all, great, I bought the property. I have this $30,000 of net worth in there. Yeah, good. When I bought it, I increased my net worth by $30,000 that day. And I own this asset, it's giving me cash flow, it's good, it's going to appreciate it. But I decide, hey, 30%, like all I had to do was I put in, let's say I did 20% down, so that's $60,000. That's a 50% rate of return day one, right? $30,000 difference compared to $60,000 in. 50%, you're like, I'm going to cash that in and do it again, right? That's what I want to do, of course. Well, what's going to happen? I turn around and I go to sell. So what do I got to do? Well, I have to pay legal fees, both to get in and to get out. Okay, so $1,000. All right, so that just reduced my profit from $30,000 down to $28,000. Okay, now what happened? Well, I have realtor fees. I got to sell this place. What's the realtor going to charge me? Typically 7% on the first $100,000, 3% or 3.5% or whatever it is, each $100,000 after that. So we're into it for $13,000 more, basically, right? So now we've gone from $28,000 to $15,000 profit on that $60,000. Okay, so we're like, okay, well, we're at 25% rate of return. Yeah, you are, but you probably have some penalties to close on that mortgage. You probably had a situation where you went and you said, okay, well, I might have had like a month of vacancy when I first took the property over to get it set up. I've got all this stuff. I might have had to pay for a property inspector. And how long did it take me to go find this property, right? It took me 100 hours, Okay, so I'm making $15,000, but I also had to tie up this money where that money could have been doing some other return for me, right? So just the time value of that money is worth something, right? So we have to account for that. Let's say that accounting for it, by the time you go through the time, it's like you can get 10%, so $6,000. It's going to take you, say, a quarter of the year, so it's $1,500 shaking out there. Like, your real rate of return on your time is not that great, okay? Not like, do you want to buy for less than it's worth? Yes, 100%. Is that where the game is at in real estate? No. Because now what's going to happen? Now you're going to pay taxes on it, okay? So let's say you made, let's see here, for an easy number, let's say that you made $12,000 after all was said and done, all these expenses out, okay, on that purchase. $12,000, you're already not looking at that great a return. It's 20%, okay? 20%? Yeah, that should be right, 20%. So 20%, okay, you're like, well, but that's 20% in a short time frame, right? So you're like, okay, well, it's still, I'm doing okay. Now keep in mind, in order to do all this transaction, you're probably spending a fair amount of time, right? So it was probably on the market for at least a month. You had to pay bills during that time. So this is probably like a 3 to 4 month process that you've gone into, right? And you made this bit of money. So how much time did that you have to put in versus going and working on some other project, right? Because this is your job now if you're doing it this way, right? Now you pay tax on that, and you're going to pay full tax, okay? So, but let's just say it was 1/3. So you lose 1/3, so you're down to $8,000. So you made $8,000 in 4 months, $2,000 a month. Not so good, right? Not that exciting a number. I apologize if you're not following along the numbers exactly. The point is, I'm just demonstrating to you how come we don't want to do this flipping thing, and how come the big deal in real estate is in the financing, not in this other stuff, okay? Now let's look at it from a flip side. Okay, I went and I bought that property for my $270,000, $300,000 value. I have an 80% loan to value rate. What can I do? I can turn around and immediately get it reassessed, and I can refinance it based on the new value. Okay, so I can take 80% of that $30,000 out. What is 80? That's $24,000. So I can immediately take out $24,000 extra, okay, from that property. I'm way ahead by refinancing it. Now I keep the asset. I still have the property, which is still making me money and all this kind of stuff. But now, instead of being in it for, I can either take that cash and go do something with it, or instead of being in it for $60,000, I'm now in it for $36,000, right? Did I have to pay tax on that money? No, I didn't, because I refinanced, right? That's not income. It's just equity that I pulled out, okay? Now I can take that money and I can go do another deal, or I can turn around and all these things, okay? So you're better off most of the time not to sell real estate. You want to buy great properties, you want to buy properties that have great cash flow, and you generally want to keep them, you want to keep refinancing them, taking that money out, okay? Next piece, so okay, that's how come it just doesn't make sense to buy for that. Let's say that you bought for that much lower, okay, and let's run these numbers. So let's say you bought for 10% lower. Okay, so now that $100,000 property goes up 5%. You didn't have to put as much into it, right? So you're now up to 15% return, okay? I think, all right, I got a little over a 15% actually, because you put in 90,000 and you got 15, so it's like 1/6, right? So 18%. So you're in it for 18% without counting the effects of leverage, okay, in the first year. Good. But now let's look at it over like 10 years or whatever. So it doubles over 10 years, okay? So it goes from $100,000 to $200,000. All right. Now what? So instead of getting 100% return, you're going to get a little over 110% return. Over 10 years, what difference does it make? Not that big a difference, right? It's like, it's a marginal, on an annualized basis, it's like a 1% difference a year, right? So the longer you hold a property, the less the purchase price matters, okay? So the reason you want to go for a low purchase price is not because you're going to make your returns there. You're not. That's not the idea. What you're going to do is you're going to buy it for sufficiently low, and then you're also going to turn around and try and add some value through renovations. So, you know, you try and put $1 in and get $3 of value out. So now instead of putting in $60,000, instead of putting in $20,000, maybe I put in $25,000. But, well, I'll say I bought it for $90,000, right? So I actually put in $18,000, and say I put another $2,000 into renovating it, which boosts its value up to, I don't know, let's say we can get the value up from $100,000 to, or say we put in, I don't know, $7,000, right? $7,000 into renovations, and let's say we can get $21,000 of increase for that. Okay, so we're into it for $25,000, and we now have a $120,000 property. Okay, $121,000. Now we can go and refinance. Okay, well, or maybe we wait a year. So it goes up in value by 5%. Okay, so we're at approximately 125, 130,000, somewhere in that range. Now we refinance at 80% loan to value. Okay, so what do we have to keep in? Well, we have to keep in about some odd $1,000, right? We can pull out the difference. We're able to pull out, say, so we have to pull out in that scenario $24,000, say, right? So we pull it, and we have the differential, which is $14,000. So most of our money that we put in, we've got back, and now we can take that money and we can turn around and go do another deal. Okay? So we're pulling out, whatever, 15,000. So we want, the ideal for real estate is to be able to take that same bit of money and like repeat it over and over and over again. So you buy low, you get great cash flow, because then you can go to a lender and you can use the value of the cash flow against your debt service ratio, which is going to allow you to go and do this. Great. And so now when you go and buy the next property, that actually enhanced your borrowing capacity rather than decreasing your borrowing capacity, right? You're great. You're like, okay, I can easily go and do the next deal. I'm setting and forgetting this. Don't worry about it. All I'm thinking is, a little later on, I'm going to refinance him again. You're going to refinance that bad boy every time it goes up a bunch. You're going to refinance, you're going to take that money, you're going to go do the next deal. And you're compounding your ownership. Again, multiply ownership, okay? That's the real estate strategy. That is like how you build lots of wealth in real estate. Hope it helps. If you want some assistance, some support, reach out to us, join the action classes. I'm going to see you guys on the next video.